Student loan refinancing. You've definitely seen the ads, right? They're everywhere, promising lower payments, big savings, a way out. It's one of the biggest and most permanent financial decisions you can make. But is it really a golden ticket, or is it more of a carefully disguised trap? Let's dig in and find out what's really going on. So to get why refinancing is such a huge deal, you gotta start with this number, $1.77 trillion. That's not a typo. According to the Consumer Financial Protection Bureau, that is the grand total of all student loan debt in the US. It's second only to mortgages. So yeah, it's no surprise that millions of people are desperately looking for some relief. And that right there is the question lenders are asking you over and over again. They see that giant pool of debt and they throw out what looks like the perfect life raft, a brand new loan, a lower payment, a much simpler life. And honestly, when you feel like you're drowning, that offer is incredibly tempting. But what if that life raft has some pretty big holes in it that you can't see from the shore? The benefits they advertise are real, sure, but they often leave out what you have to give up forever to get them. So what's the actual cost? Okay, so let's be fair. We'll start with the promise. What exactly are these private lenders offering that gets so many people to sign on the dotted line? The sales pitch is pretty simple and powerful. You could get a lower interest rate, which obviously saves you money over time, or you could stretch out your loan to get a lower monthly payment, which gives you some breathing room in your budget right now. You can also take like a dozen different loans and roll them all into one simple payment. And big one here, you can finally get your parents or whoever co-signed off the hook. All of those are really compelling reasons. But this is where we get to the real price of admission. It's the part that's usually buried deep in the fine print. See, when you refinance your federal student loans, you are taking a one-way trip. You are leaving a government-backed system for good, and there is absolutely no going back. And just look at how massive this difference is. With your federal loans, you have this whole safety net. You've got things like public service loan forgiveness. That's the one that can wipe out your debt after 10 years. You've got income-driven repayment plans that base your payment on what you actually earn, not what you owe. You've got the ability to pause payments during your crises, like we all saw during the pandemic. And there's always the chance for future broad debt cancellation. The moment you refinance, every single one of those things is gone. Not paused, permanently forfeited. Here's a good way to think about it. You're basically trading in a super reliable family car, you know, the one with all the airbags, the warranty, the roadside assistance, for a flashy, fast sports car that has absolutely zero safety features. Yeah, that sports car might look cooler and feel faster with that lower monthly payment, but the second you hit a bump in the road, you lose your job, you have a medical emergency, you have absolutely no protection. Now, it gets even worse because it turns out this trade-off isn't always explained clearly. In fact, consumer watchdogs have found that some lenders go out of their way to hide these risks. And look, this isn't just a hunch. We're talking about groups like the Consumer Financial Protection Bureau, that's the CFPB, and the Student Borrower Protection Center. These are official government regulators and watchdogs, and they have investigated this market and raised some huge red flags about how these loans are sold. Just check out this quote. A recent CFPB report called out lenders for making, and I quote, abusive, misleading statements. I mean, that is incredibly strong language coming from a federal regulator. They're not just saying lenders made a mistake, they're saying they were actively misleading people about what they were giving up. So what did that look like? Well, the CFPB found some sneaky tactics. Lenders would say you may lose federal benefits. That's not true. It's a 100% certainty. You will lose them. They saw marketing materials that just conveniently forgot to mention forgiveness programs at all. And some would offer what they called illusory benefits, like promising you could pause payments if you lost your job, but then quietly getting rid of that protection after you'd already signed the loan. So on top of the misleading marketing, there's another really big risk baked into some of these loans that can totally catch people off guard. And that would be the variable interest rate. It's a classic trap. A lot of these refinance offers will hook you with a super low introductory rate. Your first payment looks amazing, but the key word there is variable. That rate is tied to the market. So if market rates go up, your rate and your monthly payment can just skyrocket. What started out as a totally affordable loan can become a nightmare, and there's no way out. And this is not a hypothetical. This is a real quote from a borrower on Reddit. Their payment swung by hundreds of dollars from month to month. Their word for it? Brutal. It's that total lack of predictability that makes these loans so dangerous. You're basically gambling on the future of the entire economy just to save a few bucks today. All right, let's keep going. Even if you manage to dodge the shady ads and the variable rates, there are some common math traps out there that are designed to confuse you. So let's break down the three biggest ones. Okay, this is probably the most common trap of them all. A lender's website will show you a comparison. It puts your current 10-year loan next to their new 5-year loan, and wow, it shows you'll save, say, 25 grand. But wait a second, that's an apples to oranges comparison. I mean, of course you'll pay less interest if you pay the loan off in half the time. The reality is, most of that savings is just coming from the fact that you're making much higher monthly payments. The actual savings from just the lower rate might only be a few $1,000s. Now, trap number 2 is basically the reverse of that. A lender might show you a new 20-year loan, and because you're paying for an extra 10 years, the total interest you'll pay looks way higher, which makes it seem like a terrible deal. But this hides the most important part. The lower interest rate itself could be saving you a ton of money. You're just choosing to pay it back more slowly. The trick is to separate the savings from the rate from the cost of the term. And the third trap is focusing only on the total amount you'll save and completely ignoring your monthly cash flow. So imagine a 10-year loan saves you just $500 more over the entire loan compared to a 15-year loan. You might think, hey, I'll take it. But that 10-year loan might have a required payment that's $250 higher every single month. You're giving up a ton of financial flexibility for, well, peanuts. Sometimes that lower required payment is worth way more than the tiny extra savings. So after all these warnings, you're probably thinking, is refinancing federal loans ever a good idea? And the honest answer for most people is probably no. It's a very specific tool built for a very, very specific type of borrower. In fact, one of the refinance companies actually came up with a name for their ideal customer, Henry's. It's an acronym, and it stands for High Earners Not Rich Yet. And that, right there, just perfectly sums it up. They're targeting someone with a big, stable income who can afford to throw away the federal safety net because they are convinced they will never, ever need it. So what does this ideal person look like? Well, here's a checklist. Refinancing your federal loans might, and I really have to stress the word might, be something to think about if you can check every single one of these boxes. You have a very high, very stable income. You have a secure job in the private sector, not public service. You have a low amount of debt compared to your income. You have an excellent credit score, like 740 or higher. And this is the most important one, you are 100% certain that you will never need federal protections for the entire life of the loan. And at the end of the day, that really is the final question. It all comes down to this single trade-off. Refinancing isn't just about crunching numbers. It's a huge bet on your own future stability. Are you willing to permanently give up a lifetime of government-backed protections, all in exchange for a lower payment today? The answer to that question tells you everything you need to know. That's all for this explainer. We hope this gave you a much clearer picture of what's at stake with this major financial decision. Thanks for watching.